Welcome to another S&P 500 analysis. We saw some wild price action from the S&P 500 this week. Is this the last dance the S&P 500 is doing, or was the February 16 all-time high was the last dance? In this S&P 500 analysis video, we'll look at the market sentiment, the market internals, and the price action of the indexes to see what they are telling us and see if they are giving up some hints on answering this question. Stay tuned. Friday was the last trading day for the month, so let's start off with the monthly chart of the S&P 500. Starting with a positive observation, the month ended with a gain. It made a new all-time high, closed at a new monthly closing high and above the rising moving averages, and it has continued to be one time framing up. Now, the negative observations. It is overextended with 4 consecutive months above the long-term megaphone channels, closed the month at the lower half of the monthly candle, and formed a shooting star type of a candle. For the month of February, the S&P 500 had a range of almost 225 points. It closed up approximately 97 points, or 2.6% on a month-over-month basis. It closed at 3,811.15. And the all-time high is sitting at 3,950.43. Looking at this weekly chart of the S&P 500, we see a slightly different picture. For the week, the S&P 500 had a range of approximately 139 points. It closed the week with a loss of approximately 96 points, or 2.45% on a week-over-week basis. It closed near the rising 10-week moving average, but still above the 40-week moving average and beginning of a one-time framing down. The weekly trend is in flux, could be a sign of more near-term downside to come. Now let's take a look at the market sentiment and the market internal to see what they are saying before we look at some possible price movement scenarios for the S&P 500 and the other major market indexes. Here's the market sentiment chart. On the top is the daily S&P 500. In the middle is the VIX, or the fear index. In the bottom is the put-call ratio, an indicator for gauging risk appetite. We saw the VIX spiked up above the 30 on Thursday, and it closed the week at 27.95. So we are seeing market participants getting a bit more fearful. And the put-call ratio came up from the 0.4 to the 0.5 range to near the 0.75. It closed the week at 0.67, so we are seeing more put buying from the market participants. It could be putting on some hedges against possible downside. So the market participants are taking some risk off, but not totally risk off yet. Now let's turn to the market internal. On Thursday, the S&P 500 reversed from the prior day rally, and the up-down volume ratio went negative 5.7. 5.7 times more down volume than up volume. A lot of selling pressures. And the declining issue led the advancing issue by 2,458. 2,458 more decliner than advancer. And on Friday, the selling pressure is a bit less. The up-down volume ratio is negative 3.1, still 3 times more down volume than up volume. But the decliners only outnumber the advancer by 649. On the New York Stock Exchange new high, new low chart, we see there were 17 more new 52-week lows than 52-week highs on Friday. It went from previous day of 224 more new highs to 17 more new lows the next day. The most recent this has occurred is back in last October and September. And when that happened, we saw additional pullback from the S&P 500 before it bounced back up. So will this happen again this time? We don't know. We could only wait and see. But it does flag us to be on the lookout for more possible near-term downside. Here on the cumulative advanced decline line, we see it pull back along with the S&P 500 close. Nothing out of the extraordinary. For the Nasdaq market, we are seeing similar behaviors as the New York Stock Exchange. We saw a negative 5-to-1 ratio on the down volume over the up volume on Thursday, and 3,121 more declining issue than advancing issue on Thursday. The up-down volume ratio finished the week at 1.29 negative, and the decliner outnumbered the advancer by 1,134. But the NASDAQ 100 finished Friday with a gain of 81 points, or 0.63%. This is a negative diversion between the index and the up-down volume ratio, and also with the advanced decline. The NASDAQ new high, new low also went negative. 77 more new lows than new highs on Friday. Again, the last time that has occurred was back in October and September of last year. And we also saw a few more choppy days before the NASDAQ bounced back up. If this is any indication, we should be prepared for more near-term downside from the NASDAQ. The NASDAQ cumulative advanced decline is showing the negative diversion from Friday, so be careful. Overall, the sentiment and the internal are telling us to be prepared for the downside move in the near term. The put-call ratio is highlighting hedges are starting to be put on, and market participants are taking some risk off. The new high, new low is showing us those stocks near the 52-week low or breaking lower, while those that are near the 52-week high are starting to pull back from their high. This is a sign that the overall strength is starting to weaken. Again, the message is be prepared for possible more near-term downside. Now, let's go take a look at the price action of the S&P 500 and the other major market indexes and see what we might expect for the near term. Looking at this daily chart of the S&P 500, we saw the price came down and test the trend line, this trend line here a couple times. On Friday, it went below it and came close to filling this gap. With the warning message from the market sentiment and the market internal, we could see the S&P 500 come down and completely fill this gap next week. And we could even possibly see it come down to test this 3720 level. Remember, we were on the lookout for a possible repeat of this similar price action near the end of January. And the upside scenario was to look for a new all-time high. These scenarios have not changed. We are still looking for a possible move down to fill this gap completely and move back up to a new all-time high. This is not wishful thinking. This is from the statistical performance of the S&P 500 versus the E-mini S&P 500 future Globex all-time high. If you are not familiar with this price action, go watch the last two videos from me. On this daily chart of the NASDAQ 100, we are seeing the NASDAQ continue to pull back, even though it was positive on Friday, but the overall tone is down. We said we will not be surprised if the S&P 500 the market makes a new all-time high, while the NASDAQ does not, and this still remains the case. If it does, that's nice, but if it doesn't, it's expected as the market is rotating out from the tech to financial, energy, and industrial stock. So a near-term downside scenario is to move down to test this 12,439, and the upside is to come back up and retest this 13,280. And if we could move above it, then we'll watch for the gap up near this 13,600 to get filled. Now for the Russell 2000. The Russell 2000 came back and tested this upper channel trend line once again. We will continue to monitor to see if it will dip down into this price channel. And if it does, then we'll look for a possible near-term move toward this 1935 level. Be clear, I am not saying it will get there next week. It could see some choppy action near the 2050, the 2050 level, then resume downward toward the 1935. For the upside scenario, if it can hold above the trend line, then we'll continue to watch for a possible new all-time high. The Dow Jones Transportation pulled back and tested the lower channel trend line after it made a new all-time high on Wednesday. We will continue to monitor to see if it can hold above this trend line, and if it does, look for more new high. And if it doesn't hold above this trend line, then we'll look for a move down to fill this gap down here at 12,707. And finally, the Dow Jones Industrial. It looked pretty ugly after making an all-time high on Wednesday. But it shouldn't be surprising to us. Our downside scenario was to come down to fill this gap near the 31,055, and it did. And if it breaks below this intermediate channel trend line, we could see it possibly move down toward the 29,856. And the upside scenario still remain to be a new all-time high. This is based on the message from the Dow theory. Now, let me share with you on some historical tendency perspective on the market. The month of February, May, August, and November have been the month that the market chose to put market top. And the month of April, July, and October have been the month the market chose to put in market bottoms. These months do not say the market will put in a top and bottom. It only says they are highly probable for the market to put in tops and bottom in these months. But as always, there are other forces in the market that will dictate whether the market will make a top or bottom in any of these months. And for now, those forces are saying no. The S&P 500 and the Dow Jones Industrial have not put in a top in February. Now, this could turn out to be totally incorrect based on my assessment. And for all those that guess the high from February is the top, could turn out to be completely correct. But for now, until the market has proven otherwise, I will stick with what the market forces are telling me. Sure, it could be a head fake, but based on what I see, I do not see a 20% or more correction coming before another new high for the Dow Jones Industrial and possibly for the S&P 500. These are based on the Dow theory and the Globex all-time high respectively, not just on some conjectures. I do not take market top or bottom lightly. These occurrences could ruin people's life, innocent people's life. We saw that back in the dot-com era and the financial crisis, and we are likely going to see it again in this asset bubble. So with that said, good luck and be careful. Be sure to smash the thumbs up, to give it a like and help me promote and share this video. Thank you for watching and stay safe.